In early June 2026, global AI-related assets experienced a violent, resonant crash. The Nasdaq fell over 4% in a single day. The Philad app Haya Sam ICONDU CTOR Index plunged 10%. South Korea's Coincides triggered a circuit breaker. Japan's Nikkei 225 dropped nearly 4%. Was this just an accidental technical correction if we stretch the timeline to 5 years? You'll see that this fluctuation sits exactly at an inflection point of the global liquidity cycle. The tech premium of 2020, the inflation backlash of 2022, the regional collapse of 2023, the crowded stampede of 2024, a clear chain of causality is emerging. Welcome to this in-depth report. Todd I will use the coordinates of financial history to deconstruct the deep logic behind this crash and project 3 possible future scenarios. First, let's look at the full picture of this crash. The transmission chain is very clear. Start on year than expected as employment data leads to rising rate hike expectations. T pushes ASU yields higher. H valuation tech stocks face valuation compression. T triggers an Asia Pacific supply chain sell-off. FIN a shares adjust. Size chain has played out more than once in financial history. Let's do a horizontal comparison. In 2022, the Russia-Ukraine conflict ignited inflation. The Fed hiked rates aggressively. Global tech stocks fell indiscriminately. The core driver was purely macroeconomic. Almost everything fell except energy stocks. The Nasdaq accumulated a 33% decline over the year, marking one of the worst performances for tech since the 2008 financial crisis. In the West, ours had nowhere to hide. Even quality growth stocks were sold off simply because their valuations were sensitive to rising rates. In August 2024, the Bank of Japan unexpectedly raised rates. The yen appreciated sharply, triggering a massive yen carry trade unwinding. The Nikkei 225 plunged 12.4% in a single day, a record point drop in Japanese history. That was a liquidity stampede driven by currency and leverage, not by any deterioration in Japanese corporate fundamentals, but by the mechanical unwinding of one of the largest speculative positions in global finance. And this time, June 2026, the core feature is different. We are witnessing a fundamental questioning of the input-output ratio within the AI narrative itself. Unlike 2022 as macro-driven sell-off or 2024 as liquidity-driven crash, this one strikes at the heart of the AI investment thesis. One notable detail: South Korea's Kospi fell 8.29%, triggering a circuit breaker, while the Nasdaq fell only 4.18%. Why did Asia Pacific markets fall harder? The answer is what we call the amplifier effect. We anchor as assets. In this case, AI chip leaders like Nvidia begin to loosen. Asia Pacific markets upstream in the supply chain face a unique vulnerability. Markets such as Korea's HBM producers and Taiwan's wafer foundries lack sufficient local capital to absorb selling pressure, which foreign investors holding significant positions. Any withdrawal of global risk appetite hits these markets disproportionately. In 2023, when Silicon Valley Bank collapsed, TSMC's fundamentals hadn't changed at all. The company continued to ship chips, its factories ran at full capacity, its earnings outlook remained strong. Yet the Asia Pacific Semiconductor Index fell 1.8 times as much as US stocks in a single week. The disconnect between fundamentals and price action was striking, and it perfectly illustrates the amplifier effect in action. The REF the sharp drops in the Nikkei and Kospi this time are essentially an indiscriminate withdrawal of foreign capital from Asia Pacific, not a collapse of Japan's or Korea's local economies. LOCL consumers continue to spend, local businesses continue to operate. The physical economy remains largely unaffected. The selling is happening at a portfolio level, driven by global macro considerations. To understand this shock, we have to go back to 2020, a year that fundamentally reshaped financial markets in ways we are only now fully appreciating. Back then, the Fed launched unlimited quantitative easing. In a zero-rate environment, the valuation of tech stocks relied heavily on something called distant cash flows, the profits expected years or even decades into the future. Back Aussie interest rates were near zero. The discount rate applied to those future earnings was minimal. Sati made even the most speculative growth stories appear attractive. On paper, the market consensus during that period was simple and seductive. As long as there is growth, losses don't matter. Profitability was a secondary concern. Market share and user growth were everything. Tsai's mindset fueled one of the greatest bull runs in tech history. And so we saw Cassie Woody's SRK fund soar to astronomical heights, attracting billions in retail money. We saw countless SaaS companies, many with no clear path to profitability, receive billion-dollar valuations. We saw AI startups raise funds at terms that would have been unthinkable just a few years earlier. But in 2022, inflation arrived with a vengeance. The Fed, which had spent years assuring markets that inflation was transitory, was forced into an abrupt about-face. The Y hiked rates at the most aggressive pace in decades, 75 basis points at consecutive meetings, as is not seen since the Volcker era of the early 1980s. Long duration assets, those whose value depends most heavily on future earnings, crashed first and hardest. ARK-K fell over 70% from its peak. The narrative shifted overnight from growth at any cost to profits now please. Cash flow became the obsession. Period of ETA blue tech was eviscerated. From 2024 to 2026, we're facing something trickier than most investors. Expected rest rates have stayed high for far too long. Basically in 2022, when the Fed first started hiking, markets wobbled. Sure, but most people had this assumption buried in the back of their minds: once this storm passes, rates would drift back to those pre-pandemic lows, right? Well, no, the Fed held its ground. The federal funds rate sat above 5% for over a year. Market has adapted, but they adapted uncomfortably. Invest or expectations shifted. The question used to be, are you profitable now? Today the question cuts deeper. Do these astronomical capital expenditures from tech giants actually make sense? Not as something size is the simple valuation compression we saw in 2022. DAT logic was stage egg, HTF or odd rat is go up, price to earnings ratios come down. Where TV we're seeing now is more insidious, where you add ion compression layered with narrative compression. This is the new dilemma emerging between 2024 and 2026, and it strikes at the heart of the AI investment story. Look at this alarming figure. The four tech giants, Amazon, Google, Microsoft, Meta's year combined free cash flow is approaching zero. Amazon specifically saw its Q1 free cash flow crater 95% year over year. Where did the money go? One word: AI data centers, specialized chips, liquid cooling systems, long-term energy contracts. The capital demands of this AI arms race are staggering. Hundreds of billions of dollars poured into infrastructure with no clear path to returns. Nobody knows if it pays off. We've seen this movie before. The parallels to early 2000 are striking. Basically then, telecom giants borrowed aggressively to lay transoceanic fiber optic cables. Free cash flow was deeply negative, but the narrative was irresistible. This would be the scarce resource of the new economy. Whoever controlled the pipes controlled the future. We know how that ended. The telecom bubble burst. Global Crow SSING World LD names liquidated in bankruptcy. So USANDS of miles of dark fiber, sat unused for years. Investors lost trillions in today's dollars. So the question becomes, is this time different? We need to be precise about the distinctions. In 2000, companies borrowed to chase .com dreams without real revenue backing them. Most internet startups had no business model beyond get big first. The Y sold dollar bills for 90 cents, hoping to figure out my ATZ ion later. Few ever did. In 2026, companies borrow to chase compute. The crucial difference: their income statements look fine. By traditional metrics, they're profitable. CLOD revenue still growing, int ERP race e-software still earning, no red flags on the PL. But this is if rate hinges, e-cash flow statement is already flashing warnings. A pretty income statement is one thing. Cash flow is oxygen. When CapEx nearly consumes all operating cash flow, your margin for error disappears. Any disruptive revenue growth slowing, costs spiking unexpectedly, financing getting more expensive can spiral into liquidity crisis fast. Factor in the lessons from the 2022 to 2023 crypto collapse, and this concern sharpens. Look at what happened to highly leveraged miners like coincides and IC. In the bull market, they borrowed heavily to buy mining rigs, betting rising crypto prices would cover their debt. The N prices crashed. The Y faced a brutal arithmetic. Operating costs stayed rigid while revenue collapsed, forcing asset sell ECNCLUDING the rigs. The MCLV set fire sale prices, driving prices lower in a death spiral. Now map this onto the AI ecosystem. For 2 years, AI startups have relied heavily on convertible debt financing debt that converts to equity later. Size structure let them raise money without immediate dilution, but it loaded their balance sheets with fixed obligations. If AI financing conditions that airy aura TF, the narrative shifts from limitless potential to uncertain returns. These highly leveraged AI startups could be the first dominoes to fall. Convertibles become impossible to roll. Cash burn rates that looked acceptable in bull markets become existential in bear markets. Psi is the signal of a miscimum into a sudden collapse in asset values, triggering broader confidence crisis. Economist Hyman Minsky coined this term to describe the tipping point where prolonged speculative investment hits its limit and rapidly reverses into delve wrecking. We may not be there yet, but the warning lights are blinking. Let's shift from macro to market mechanics. CLWD trades are always danger as too many people piled into the same position. Exits become brutal. But the trigger mechanisms for each recent blow-up have been completely different. Let us dissect 3 distinct episodes of extreme crowding. Episode E1, Yearly 2021, The Red L Arm Y. Gam STOP MC. Here we shorted stocks driven parabolic by Reddit as well as TBEs. Where team made this unique was decentralization. So USA NDS of retail traders informally coordinated to squeeze institutional shorts. Gam STOP surged over 2,000% from its lows. The infrastructure broke cap Rockera, just like Rob Inchwood restricted trading citing margin requirements. The SEC threatened regulatory action, momentum died. In the IVI dual stocks fell 80% plus from their peaks. Meanwhile never recovered. The essence regulatory intervention killed the narrative. The story of retail permanently challenging institutions was compelling, but once rules were enforced, it co-LDNT sustain. Episode E2, July-August 2024, The Yankaritra de unwind. Massive foreign leverage had piled into Japan securities, funded by near zero yen borrowing. The trade looked like free money, borrow cheap yen, buy attractive Japan stocks, capture the spread. The Bank of Japan surprised markets with a rate hike. The math flipped instantly, yen surged. Repayment costs exploded, carry trades unwound within days. The Nikkei dropped 20% from its peak, technically entering bear market territory as foreign capital fled. But here is the crucial distinction. Japanese corporate fundamentals held dear, R9NGS kept growing. Balance sheets remained so IDA ND markets V-shaped back within 2 months. The selling was mechanical, not fundamental. Episode A3EE, The AI Hardware Retradio NFOLDING. Now, the third extreme crowding event is happening as we speak. AI hardware NVIDIA and SK hikes as the core wish ICLSS become the most crowded trade in global markets. Hundreds of billions bet on one premise: AI compute demand grows exponentially for years ahead. The narrative holds together for now. OpenAI and Haro Peak Flow NTI models keep advancing. Inference demand is indeed expanding. But crowding itself becomes the risk when everyone's on the same side. Any crack in the narrative can trigger cascading position reductions. More subtly, this time the fundamental and Horsey BM chips, CoOS packaging cap AC tire real physical constraints. Unlike the pure financial engineering of yen carry trades, where does this mean if demand side disconfirm at INMRGSAY enterprise AI spending fails to deliver ROI, or frontier model progress hits botanic case adjustment, when TB August 2024 as quick, V recovery. It could be a prolonged valuation repricing. The R supply shock looms. SpaceX, OpenAI, and Arch Peak all queuing for IPOs, each carrying massive funding needs. When these mega unicorns simultaneously tap public markets, simultaneously existing capital gets diverted. Mid-cap and small-cap tech stocks feel the squeeze first. TRE stampedes. 3 mechanisms. 2021 was regulators killing narrative. 2024 was macro factor reversal. 2026 could be fundamental disconfirm mad iron layered with supply flood. Historical dose NT repeat, but the rhymes are getting more dangerous.